Bitcoin just dropped from $80,000 to $60,000, a $20,000 move in a matter of weeks. And I want to show you how I called this. Not after the fact, not with a vague prediction, but with a specific entry at $80,907 and a target right at $60,001. This chart on screen right now has both of these marked. The entry, the target, time-stamped before price got there. In this video, I'm going to walk you through every single decision I made using two ICT concepts, fair value gaps and liquidity. That's it. With no indicators, and by the end of this video, you'll be able to read the same setup yourself. This wasn't a guess. It wasn't someone on Twitter telling me that BTC was going to crash. It was a framework. The same framework you can learn and apply yourself. If you ever looked at a chart and felt like you were missing something obvious that other traders could see, this video is for you. By the end of it, that gap closes. The roadmap. 3 reads that built this trade. Here's how I'm breaking this down. Step 1, the range. How I identified the dealing range, Bitcoin was operating inside, and what it told me about where price was going. Step 2, the fair value gap, the exact fair value gap that acted as the short entry, why I trusted it, and what made it high probability. Step 3, the liquidity target, how I knew $60,000 was the destination before price got there, and what the chart was telling me the whole time. 3 steps, one $20,000 move. Let's get into it. Step 1, the range. How I built the dealing range on the weekly chart. The first thing I did was zoom out, not to a 4-hour, not to a daily, to the weekly. Because when you're looking for a $20,000 move on Bitcoin, you need a higher time frame framework. One that tells you the story of where price came from and where it is designed to go. On the weekly chart, I could see that there was a clear dealing range between 2 clear structural swing points. You have a structural swing low formed back here in late January and February. Price had been ranging, compressing, building. Then you have a rally up to the mid 70s. That gave me my range. Swing low at the bottom of the accumulation zone and swing high right here up these recent highs that's approaching towards $80,000. Now, I apply the 50% rule. The 50% of this range, which sits around 66,000 to 67,000, anything above that is premium. Anything below is discount. Bitcoin at $80,000 was premium territory. That's expensive. That's where you look to sell and not to buy. That was my first trade. The bias was bearish. Price was in premium. I was looking for a reason to short, but bias alone isn't a trade. I needed a specific reason for price to turn at a specific level. That's where the fair value gaps came in. Step 2, the fair value gap entry. A fair value gap is a 3-candle pattern where the middle candle moves so aggressively that it leaves behind a gap. Price left that gap because the algorithm had moved too fast to fill every order. Now, what does price do with unfilled orders? It comes back to that. Here's what I was looking at. Earlier in the rally, as Bitcoin climbed from the mid 60s to 70s, there was a significant displacement candle towards the upside. That candle created a fair value gap. I had the zone marked. I knew that price was likely to retrace back into it. And when price rallied into the low 80s and started to stall right around this 80 to 83,000 level, I checked and there was a fair value gap right there at $79,000. Now, look at what else was true at that moment. I was already in premium on the weekly. Price was trading into an unmitigated fair value gap. That's when I marked the short, one short entry at 80,907 and I let it run. Because the third piece of the puzzle, the target, had been sitting in the chart the entire time. The entry was called before price moved. I want to be clear about something. I'm not showing you this after the fact and telling you I saw it. The entry at 80,907 was marked before this move happened. You can see it on the chart. That's not a drawing I added today. If you've been following the community or the post, you know this call was public. I'm showing you the trade because the concepts deserve to be explained and show you that this works. Anyone who understood fair value gaps and premium and discount at that time could have read this setup. That's the whole point of this video. Now, let's get into why $60,000 was always the target. Now, here's the part most people miss. They find a reason to enter a trade, but they have no idea where it's going. The target isn't a guess. It's not a round number chosen because it sounds clean. It's the next liquidity pool in the direction of the move. Look at this chart. Below the accumulation range, below the swing low that started all of this, sits a cluster of sell-side liquidity. The stops of every long trader who bought during February and March All of them are sitting right at this low, below this exact $60,000 level. That is the magnet. That is where smart money needs price to go to fill their orders. $60,001 was my target because that's where the liquidity is. Not because $60,000 is a psychologically significant number, though it is, but because the chart told me that is where the liquidity was. And look at what happened. Price moves all the way from $80,000 all the way down to $60,387. Now, that buy arrow you see on the chart right here, that is the sweep. Price swept those through $60,000. Grab these stops at the time of this video and you can see the reaction beginning. Almost $20,000 of downside called with two concepts: fair value gaps for the entry, liquidity for the target. What does this prove and what it doesn't? Now, I want to be honest with you about something before we wrap up. One trade doesn't make a strategy. One correct call doesn't make someone worth following. What matters is whether the logic is repeatable. And that is what I want you to take from this video. Not the fact that I got this right, but the process. The range, the fair value gap identification, the liquidity target. That process works because it's based on how the market is designed to move, not on a prediction about what it will do. You can apply it to any market on any time frame. That's the framework. Let me show you how to use it yourself. Here is the exact 5-step filter I used on this trade. 1. Zoom out to the weekly or daily. Identify the swing high and swing low that form your dealing range. 2. Determine whether price is in premium or discount using the 50% midpoint. For a short, you want price in premium. For a long, you want it in discount. 3. Look for an unmitigated fair value gap inside the premium or discount zone. A gap from a prior displacement candle that price hasn't returned to yet. 4. Wait for price to trade into the fair value gap and show rejection on lower time frame, which can be a change in state of delivery. 5. Identify the liquidity target in the opposite direction. A cluster of stops between a previous swing low for a short, above a swing high for a long. That is your target. 5 steps. This is how a $20,000 Bitcoin move becomes readable before it happens. The two things you're probably thinking right now is this is hindsight, you can always see it after. I've addressed this. The entry is timestamped, the call was public, but more importantly, go find any major move on Bitcoin over the last 2 years. Apply this 5-step filter, you'll find the fair value gap. You'll find the liquidity target every time. This isn't about Bitcoin specifically, it's about how price moves. I tried fair value gaps and they don't work. I'll tell you exactly why. Because you're using them in isolation. A fair value gap in discount with no liquidity context is just a gap. A fair value gap in premium with a liquidity target below and a dealing range framing the entire move, that is a trade. Context is everything. Remove the context and the concept stops working. Now, this Bitcoin call wasn't a one-off. Setups like this get broken down live inside the Discord community before price moves. Not recaps, not I would have taken this. Live calls, live charts with live reasoning. When I saw this fair value gap at 80,907, I posted in the community. Members who were in the community at the time had full context, the range, the entry level, the target. That is what being inside gives you. That direct feedback loop is what turns a concept you understand into a trade you can execute with confidence. If this video showed you something real, the link to join is in the description. Come be in the room before the next move happens. Now, open the Bitcoin's weekly chart, find the current swing high and swing low, mark your 50% midpoint, identify where price is sitting, premium or discount, then look for the nearest unmitigated fair value gap. Just mark it, don't trade it yet. Watch what price does when it gets there. Do that this week and you'll understand this framework better than most people you've been trading for years. Subscribe for the next breakdown and drop BTC in the comments if you want me to do a live updated analysis on where Bitcoin goes from $60,000, and I'll see you in the next one.